Welcome, everyone, to a new look at reverse mortgages and, in general, how to use housing wealth as part of a financial planning tool for financial planners. My name is Steve Dubin. I am your host. My company is PR Works based in Plymouth, Mass, and we help clients with webinars and other tools. I'd like to introduce George Downey as our presenting host today. George has more than 30 years of experience in the mortgage industry in the financial field. He is among the early adopters and developers of reverse mortgage in the country. He is one of the only 170 certified reverse mortgage professionals in the country. He is on the board of directors for the Mass Mortgage Association. He is on the board of directors of the National Association of Reverse Mortgage Lenders. He is very active in community service and and he was on the board of directors with the Greater Boston Food Bank and worked with Boston College to set up a program for food rescue with restaurants and other food vendors to get food to people who needed it. He's also the past president of the Boston College Alumni Association. And with that, George, let me turn it over to you and please provide us with information.
Well, thank you very much, Steve, and welcome everybody to today's session. Today, we're talking about reverse mortgages, which I think is, I was going to say arguably, but not arguably, is really somewhat of a controversial topic. Excuse me. The reverse mortgage has emerged to be a very valuable and versatile financial planning tool that very few people, including financial professionals, really understand. Recently, the National Council on Aging announced that home equity, or housing wealth as we're referring it to, for senior homeowners, has now reached $10.5 trillion in value. And that is an enormous resource that can be, if properly, it can be used to increase and extend retirement security. Today, we're going to do a bit of a deeper dive into reverse mortgages, and I would call this Reverse Mortgage 101. Really, it's to explain what they are, what they're not, and some general ideas on how they may be used. We'll be following this up with other sessions that do more in-depth analysis of different strategies that can be used. So to move things along, if you don't mind, let me switch off here and go to the PowerPoint presentation. So the title again, a new look at reverse mortgages, what advisors need to know and clients need to learn. Our agenda today is, first of all, to clear the air. There are many misconceptions and negative reputations about reverse mortgages, and also to learn what the reality truly is. It's overlooked as a planning tool. You know, most financial planning protocols deal with people's financial resources and how to order and reorder them to meet clients' needs. But to a large extent, housing wealth or home equity is kind of off to the side and has not been a standard resource in the planning process. However, it can be, and frankly, should be. Next, client communications. Especially in these times right now, we're in kind of no man's land as we're hopefully coming out of the pandemic. We've got supply chain issues, we've got inflation, we have international problems, and we have great concern and anxiety about where the economy is going. From a retirement planning perspective, it's time to circle the wagons and to protect, most importantly, to protect what we have. Next, lastly, we'll be introducing, we're providing a service for financial professionals that enables financial advisors to have private consultation to assess whether or not a reverse mortgage may or may not be a good idea for individual client needs. We'll talk more about that later. First, let's deal with some most common misunderstandings that we hear from financial advisors. And very commonly, the initial reaction is, my clients don't want or need them. Number two is, I don't like them. You know, everybody knows they're the loan or last resort. And clearly, that's not my client base. Maybe we might consider one someday if it's absolutely needed. It's too restrictive. You know, the home has to be debt free. Now, all of these are not true. Here's the big one, is that we're not interested in this because, as we know, the bank takes ownership of the home, so we're clearly not interested. And lastly here, the home is a legacy asset for the kids. You know, we don't touch the house. It's the inheritance for the kids. These are very common misunderstandings that unfortunately distracts people from taking the time to learn more about them. And another one is that lenders charge excessive fees on these, and that home equity lines of credit are a better choice. As we get deeper into it, you'll see that that these issues are greatly exaggerated. Preliminary actions. This is a common reactions from financial advisors. And when a recent survey that was done, where they were asked, how many of your clients could use a reverse mortgage? And the typical answer was very few, maybe 5 or 10%. The next question was, how many of your clients are concerned they will be financially insecure in retirement? Not what you think, but what they think. And the answer was most, 80 to 90%. I think, as we all know, the number one concern today among people across the country is the fear of running out of money. Then lastly, the question was, what if there was a resource that could improve their cash flow, provide more liquidity, reduce sequence of return and other longevity risks? How many would want you to tell them about it? And the answer was all of them. So that's the basic scenario platform that we're looking at. So from a planning perspective, really we have two kinds of clients that have immediate needs and clients that have perhaps longer term needs. From a planning perspective, it's commonly perceived that the reverse mortgage is for what we call needs-based people, and these are people that are financially distressed and they have nowhere else to go, and that could be true for many of them. But what we're talking about today is really more affluent clients. So the ideal planning client, which is now called the mass affluent, are clients that are in their 60s and older and typically have assets of anywhere between 500,000 and 2.5 million. That's the ideal cohort that we're talking about today. The unique features of the reverse mortgage provide that, first of all, when you have a reverse mortgage, there's no payment obligations, unlike any other debt obligation. There's also no maturity date to it. They can stay in their homes as long as they want or are able. And if they want to prepay, there's no prepayment penalties associated with it. Number two is that they are able to, with the reverse mortgage, they're able to utilize a portion of the equity that they have accumulated, and their withdrawal strategies now are quite versatile, and we've seen in many cases that that people in retirement have large mortgage or other debt obligations, and they are withdrawing payments from investment or retirement accounts, and they're cannibalizing their investment portfolio to make mortgage payments. Also, the terms of the reverse mortgage are guaranteed. Unlike many other home equity release options, these are guaranteed terms, and depending upon which program they choose, they can either have cash up front or access to a credit line for future draws. There's no personal liability with a reverse mortgage. Now, this is unique. This loan is called a non-recourse loan, which means that neither the borrowers nor their heirs have any personal liability for the loan. It's the only loan of its kind where there's no personal liability involved. Trust ownership. Many people transfer their ownership of their homes into a revocable or irrevocable trust, and it has been assumed that you can't have a reverse mortgage with a trust ownership, but that's not true. We have to review the trust documents, and if necessary, there are certain adjustments might need to be made to them, but trust ownership is possible. There's no maturity date to the loan. One of the purposes of the reverse mortgage is to enable people who want to age in place to have the secure knowledge that they can stay in their home indefinitely. And next is that the balance owed can never exceed the future property value. Now, because they're not making mortgage payments, the interest that is charged accrues. It accrues and it gets added on to the loan balance. So really what we're doing is we're chipping away at the home equity. We call that negative amortization. Now, in the future, we have no idea what future property values will be, nor what the loan balance will be. That will depend upon how aggressively the money is utilized. But it's also conceivable that they could be upside down, meaning that at some point in the future, should property values decline, is that they could wind up owing more than what the property is worth. However, every reverse mortgage has a provision is that the balance that they eventually owe can never be greater than the property value in the future. One of the key objectives of the reverse mortgage is to improve cash flow. So with the reverse mortgage, if there's any liens or mortgages on the property and so on, they have to be paid off. So the reverse mortgage will pay those off. It must be a first lien in the property. Of course, as a result of that, any payment obligations that they have will be extinguished as well. So that will help cash flow in terms of extinguishing or reducing payment obligations that they have now. Number two is that equity, home equity that may be available to them in addition to their payoffs, that is available to them in a variety of ways, not only to meet future obligations, but potentially to either maintain or to improve their lifestyles. Liquidity. Clearly, as we know, from a planning perspective, the two ultimate objectives in financial planning is to improve cash flow and liquidity. So cash flow can be improved. Now, in terms of increasing liquidity, we call this a buffer asset. So in other words, the funds that could be available from a reverse mortgage really are separate and distinct from any other financial assets that they have. Effectively, what we're able to do is to convert an illiquid asset, home equity, to a liquid asset that can be drawn if and when needed. The funds that are drawn can be used for any purpose. So there's no restrictions on the use of the money. People can be prudent or they can be foolish. Clearly, prudence is highly recommended. The funds are commonly used to sustain or maintain their current lifestyle, or perhaps to enhance their lifestyle. And we've seen it with a number of clients as well, is that it provides additional funds for discretionary funding. We've seen them be used to purchase a second home, an RV, or for travel. We've seen them used help to fund grandparents funding grandchildren with college costs as gifts. Tax planning, it has some tax effects. For example, funding Roth conversions. For those that can take advantage of Roth conversions to come up with the upfront funds to facilitate the Roth conversion, the reverse mortgage could be a source of funds that could make that possible. The withdrawals that are received from a reverse mortgage come income tax free. And the reason for that is that it is not income. So there's no federal or state income tax, perhaps unlike other withdrawals that people may be utilizing if they're drawing from tax advantaged accounts like IRAs and 401ks. Those withdrawals generate an income tax obligation. Here is an opportunity to access withdrawals without incurring a tax liability. It is used as a mechanism to delay receiving Social Security benefits. As we know, Social Security benefits are deferred until age 72. One can significantly increase lifetime income, but you need to have the cash flow to get through the years until age 62. The reverse mortgage could be a source of that. And also, this provides funds for perhaps for contributions to other tax advantage investments or insurance. Retirement planning also is important to manage risk. One of the current risks that everybody is concerned about is sequence of return risk. Something that, and as people are withdrawing from investments, especially as they're making systematic withdrawals in a declining investment market, they are cannibalizing and reducing their investment portfolio. There is a very effective strategy of coordinating withdrawals between the investment portfolio and the reverse mortgage. We do a whole separate webinar on this subject, but the differences in being able to preserve assets is significant. Longevity risk, as we mentioned earlier, is the number one risk people have today, almost regardless of their circumstances, is the risk of running out of money. And again, what we're able to do is to tap into the ability to use some of that home equity to increase their financial security. Healthcare risk. We all face the unfortunate probability of declining health as we age, and how is it going to be paid for? Do people have long-term care insurance? Do they need to purchase it? If they need assistance and they use in-home care services, that has to be paid with private funds. If they go to a nursing home, how is that going to be funded? So the healthcare risk issue is a significant one. And the reverse mortgage, again, provides liquidity to help to fund those needs. And it provides what we're calling here a virtual hedge. And as with the reverse mortgage with the line of credit, is that the line of credit is unique. This line of credit, actually, the undrawn portion of the credit line actually grows. And it grows at the same rate as is charged on the funds that people have already borrowed. And this is an adjustable rate program, so that as interest rates increase in the future, if they do, although they will be charged more on their funds borrowed, the credit line growth rate also increases at the same rate, and it compounds monthly to provide more funds later on. So in a real way, it provides a virtual hedge against increasing interest rates. Similarly, if property values decline with the reverse mortgage, we are guaranteed not to owe anything more than the value of the property at the time eventually when it's repaid at some point in the future. If that property value is lower than what is owed on the property, whatever the deficiency is, the borrowers or their heirs are not responsible for it. So again, that's a hedge against property value declines. There's no maturity date. As we have a beginning date, we have no maturity date. The loan never comes due until no borrower continues to reside in the property and that the loan remains in good standing. And typically the loan would only mature when, number one, they decide to sell the property, which they can do at any time. There's no repayment penalty. They sell the home, they pay the mortgage off, and they move on. Number two, when the last borrower dies, then the loan matures, and then the loan has to be repaid at that point. Again, the payoff balance can never be greater than property value. And we say that as long as the loan remains in good standing, that brings up what the obligations for the borrowers are. And there's three things that the borrowers must do, and only three things. Number one, they must keep their property charges current. That's typically real estate taxes, homeowners insurance, or condo fees. They've got to be maintained current. Number two, they have to provide basic maintenance. They don't have to improve the property, but they've got to maintain the property. And then the third thing is that they have to live in the property as their primary residence. So there's so those are the only obligations they have. If they do those, if they do those three things, the loan can never be called. And the terms are guaranteed. They cannot be changed for the life of the loan. To exaggerate, if somebody did all of these things and they lived to be 120 and they're still living in the homes, that loan cannot be called and they can be assured they can stay in their homes. How they work? Okay, well, there's two types of mortgages, reverse mortgages today. The number one is the home equity conversion mortgage, popularly called the HECM. This is the HUD FHA insured reverse mortgage. It actually began in 1989 under the Reagan administration. It's gone through a number of changes over the years and so on, but it is the dominant program constituting about 95% of all reverse mortgages today. One of the limits on this is that this program is today is appropriate. Well, the maximum value that can be utilized here is about $970,000. So for property values that are higher than that, and this is true for the audience that we're talking about, we have what are now called proprietary or jumbo reverse mortgages. Here in Massachusetts, they were just recently approved by the Division of Banks in 2020. But now we have these for higher valued properties, and in fact, we can do loan amounts up to $2 million. So at this point, what I'd like to do would be to come in and to demonstrate how it works. Let me go through this navigation here and come back. Okay. Now, this illustration I'm showing now, I assume everybody can see this. Steve, is this visible now? Where it says borrower details.
George, it looks good. Thank you.
Okay, thank you. Okay. So here we have, this is a borrower. By the way, the minimum age for to do a reverse mortgage is age 62. So here I put a date in of 1960, which makes this individual 62 years of age. And I just plugged in and assumed the value in Massachusetts is about $800,000. And initially, this is the fellow that owns the home. There's no mortgage on the home. And here I just put in a Massachusetts zip code. So now we can calculate what these benefits might look like. Okay. So with a property value of $800,000 for 62-year-old individual, the principal limit, the amount that he would be eligible for, is determined by a formula that includes his age, the property value, and the current, what's called the expected rate over here. So that amount in his case would be $311,200. We're assuming here that he does not have a mortgage on the property. And just for purposes of this illustration, I'm assuming that there are no costs involved. There are costs involved, and we can get into that. But for the purposes of just demonstrating the concept, because there are different costs associated with different program options. So I'm just eliminating that for the moment. So in this case, this individual would now be eligible for a credit line of $311,200. We can take a look at how. Just a minute. Now we'll show a chart. All right, this gives us now he's eligible for $311,000. This illustration now shows his property value and his home equity growing, and that's the blue line there. That's the $800,000, and the government's the default assumption is that average appreciation will be 4%. So that shows appreciation growing at 4% per year. And you see the credit line here now. The credit line, as you see, is growing. In this illustration, we're assuming that there are no withdrawals being made. So the undrawn portion of the credit line is growing. Now, that, excuse me just a second, that chart is backed up by this data set over here. Now, here we're showing the amortization schedule and what the numbers would look like year after year. We're assuming that the property is growing here at 4% per year. In this, with this program, it's an interesting program because all these columns here, these 4 columns, we can do what if analysis, so we can simulate increased or decreased appreciation, withdrawals, increased interest rates, and so on. We can use this to simulate a variety of options for people. You can see over here now with the line of credit, you can see how it increases every year. So after year 1, they've got 327,000, the next year 344,000, and so on. So coming back to the assumptions here. Let me come back and change the assumption here and assume that instead of having no mortgage on the property, this individual has owes, let's say, $100,000. $100,000 on the property. Now let's look at the graph. Okay, little different situation now. The black line shows the property appreciating at the 4% per year. The red line down the bottom shows the balance that he owes. In this case, he owed $100,000. We paid it off. And then going forward, the interest is going to be added onto the loan balance. So the loan balance is going to be increasing, and you can see how it is chipping away at the home equity. The green line is his credit line. If that money is available to him, he can withdraw it in a number of ways. He can take lump sum withdrawals, he can have periodic payments, he can just let it sit there and to accumulate. And the blue line shows what the net equity would be. In other words, if he sold the house at that time. So let's go out 5 years, for example. In 5 years, his house presumably would be worth $1,052,000. His loan balance has accrued to be $143,000. His credit line now is $302,000. Remember now, we paid off the existing mortgage, and so you can see if he sold the house at that time, he would have he'd pay off the loan balance, and his net equity would be about $909,000. And again, that addresses one of the key misconceptions, is that when you have the reverse mortgage, is that you're giving up all the equity in the home, and it just is not true. Let me come back to that chart over here now, and let's do a little simulation. Okay, so this individual, he's 62, he's working right now, he's making mortgage payments on his $100,000 mortgage. And what we're simulating here is that he swapped his current mortgage for the reverse mortgage. And as we've demonstrated, he doesn't have to make any mortgage payments. But let's say that he did. For example, let's say he's making mortgage payments. He's making mortgage payments right now of $1,500 a month. If he does nothing, what would he do? Well, he'd continue making his mortgage payments. In here, let me simulate that to assume that he continued to make his $1,500 payments. Now, he's doing that. I click this will autofill now we can look at the chart. And some very interesting things happen here. So here, he is making his $1,500 mortgage payments as he is currently. Here's his mortgage balance. His mortgage balance is declining, where he's paying it off and he knows nothing or next to nothing on the house. And this would be in a little over 5 years, I guess. But look at his credit line. His credit line is increasing every time he makes a voluntary payment of $1,500. He not only is decreasing his balance owed, but he's increasing his credit line, and that credit line is growing and compounding at the same rate. So we get out here, say to year 6, he's paid his loan balance off. The house is worth $1,052,000. That's his net equity because he doesn't owe anything in the property. However, his credit line has grown to be $445,000. So if he continued to live in the property, he doesn't have any more payments to make, and he's got the credit line available to him. Let's look at a practical situation. All right, so now he's made those payments, and let's say it's his objective. He's going to work till, let's say he's going to work till he's age 70. That's his plan right now. But at that time, what he wants to do, he wants to retire. And just for the heck of it, let's say that his financial plan shows that what he wants to do at this point is to draw $500 a month to supplement whatever his retirement income is. So we can plug in the $500 as a monthly charge. We can make that be any number we want, actually. We're going to autofill that. Come on. Okay. And at this point, when he turns age 70, he wants the house to support itself. So he wants it to be able to carry his real estate taxes and homeowner insurance. And let's say, for argument's sake, that he wants to have annual withdrawals here to cover those costs of $10,000 a year. So he wants to take out $10,000 a year in addition to the $500 that he's taking to augment his income. So okay. Now let's look at the chart. Okay, so now we see that his loan, the red line is loan balance, he paid it down, but then he began to draw funds out. And we can see the effect. And look at the effect on the credit line. Well, the credit line grew in these early years, and then it started to decline. But in fact, the credit line growth rate here increased at a rate greater than what he was withdrawing it at. So if we went out 10 years, 10 years now, his loan balance would have grown to be $72,000. He obviously has no payment obligations. He's receiving the $500 a month and the $10,000, and he has a credit line of $474,000. We go out 20 years. His credit line has now grown to be $580,000. His loan balance is $332,000. So here's a way is that we're able to go in and to simulate client situations to get a sense of would the reverse mortgage make sense for them. Now, everybody's situation is going to be different. And again, if we go back to the amortization schedule, we also can say, well, let's look at a worst case scenario. I don't know, worst case, the government assumes that the property is going to grow at 4% per year. Let's draw a worst case analysis. Let's say it doesn't grow. The property values are at their highest we've ever seen them. What happens if that doesn't change? I'm going to change that to 0. Now let's look at the chart. Okay, different situation. Here's his $800,000 value. It's flat. His loan balance, as we saw before, has been depleted. It's growing up. His home equity, and we get out to this point in about 30 years, and we can see that he still has a credit line available of $735,000. Let's look at, for demonstration purposes, let me go back here and actually show negative amortization. Let's say that we start in amortization declines by, I don't know, 2%. Oops. Come on. Program's being a little blocky here. All right, there we go. Now let's look at the chart. Okay. Now, what we've seen here now is property values are going. Let's say we've gone into an economic meltdown. Interesting points here. Here, at this point right here, this is a crossover point. As you can see, the loan balance exceeds the property value. So we went out here to age, age 27. He owes $613,000, but the property is only worth $463,000. That deficiency in there is he's not responsible for. Let me say that again. That deficiency they're not responsible for. On the other hand, he still has a credit line down here. Whoops. He has a credit line of $694,000 that's available to him. Even though the property value declines, is that the credit line is not affected by that, and that credit line availability is guaranteed to them. So there's a lot of dynamics working here, and this becomes an incredibly valuable financial planning tool. So so that is just some basic ideas on how we can be looking at and using the reverse mortgage. We can look at the proprietary mortgage. The proprietary mortgage, and given the time limitations today, I won't get into it, but it works in a similar fashion. And we can do loan amounts up to $2 million in Massachusetts. That requires a little different analysis, but that is where we are there. So, Steve, let me come back to here. Trying to get back into my program again.
George, it seems that you've covered the topic fairly well, because there's only really one question from the audience, and that is, well, it's sort of a dual question. When are people available? When is a reverse mortgage available to people, and typically at what age do you see customers take advantage of it?
Yeah, well, the eligibility, Steve, for the FHA program, the minimum age for a homeowner has to be age 62. For the proprietary program in Massachusetts, it's age 60. So at least one homeowner has to meet those criteria in there. But we commonly see people in their 60s and 70s is most common. We're in the process of working with a woman right now that's age 100. There's no upper age limit on it. Matter of fact, the way the formula works, older people are entitled to more money from the equity because actuarially their life expectancy is shorter.
Okay. And then actually there was one other question. Do you work with clients out of state?
Well, the answer is yes. We work with advisors at the moment. Harbor Mortgage, our company, we're licensed in Massachusetts and Rhode Island. We have plans to expand that, but at the moment we're dealing with Massachusetts and Rhode Island. However, we work with consultants, and we provide the advisory service to consultants, regardless of where their clients are. And if it's appropriate for them, we can refer them to colleagues in other states.
Okay. So those are the questions.
Okay.
Do you want to wrap up?
I will. And yeah, in our financial, and on the screen now, hopefully you can see it, is this is what we're offering to financial advisors is a consultation service. And it's a private service that we provide to individual advisors to enable them to evaluate and assess, the potential value a reverse mortgage might provide for individual client needs. So we can help the financial advisors to get a sense of whether this may or may not make sense for an individual client. And then if it does, we can provide the supporting materials and assist them as they may, if they choose, in communications with the clients as well. And for our participating financial advisors, we provide each one of them with a copy of Dr. Wade Pfau's new book, which is is really the Bible on reverse mortgages. It's the third edition. It just came out. And reverse mortgages, how to use reverse mortgages to secure retirement plans. So that is a great piece. And then additionally, for advisors that choose to participate with us, we're providing them with ongoing, not only consultations and so on, but newsletters and updates on best practices, that type of thing. So with that in mind, if people are interested and they want to learn more, this is my contact information. And here I've called myself the head coach, and I did so really just to communicate what we really do here. This is not about selling the reverse mortgage per se. It's really about coaching not only professional advisors, but their clients, coaching them on the potential merits, I emphasize potential, to a client situation. Everybody is different. So being able to do an analysis to determine if and how housing wealth, can increase and extend their retirement security. The reverse mortgage is the primary product that's available today. And there were new products, equity release products coming into the marketplace, which we can discuss as well. They work a bit differently, but this is now a growing trend. So with that, Steve, that is our contact information. I'd love to hear from people. And if they would like, we'll be happy to send them a copy of Dr. Pfau's book and to help them evaluate any client situation.
Okay, George, thank you so much for the presentation and for those who are with us. Again, if you have additional questions, you can either call George at 781-843-5553 or email him at georgedowney, GDOWNEY @harbormortgage.com. And we will also be sending out this recording so folks can share it with their staff and others who might be interested. So thank you for those who joined us today. And George, thank you so much for your presentation.
Well, thank you, Steve, and thanks everybody else for your time. We look forward to hearing from you.
Welcome, everyone. My name is Steve Dubin. I am the producer of this webinar. I wanted to introduce our presenter today, George Downey, who has more than a decade of experience on the board of the Mass Mortgage Association and is currently on the board of the National Reverse Mortgage Lenders Association. He is also a columnist for the South Shore Senior News. He was a chairman of the board of the Greater Boston Food Bank in a rescue project with Boston College to rescue usable food from restaurants, hotels, and other institutions. George is also a past president of the Boston College Alumni Association. And with that, George, please tell us more about today's topic, which is how to leverage housing wealth in ways that can enhance retirement.
Well, thank you, Steve, and thanks for everybody for joining our session today. Well, the title of this webinar is A New Look at Reverse Mortgages, but what it's really all about, it is about a recognition of home equity and the significant value that home equity represents today, and how that home equity can play an important, if not a vital role in the financial planning process, which historically it has not been an integral part of financial planning. Now, reverse mortgages are one of the ways that home equity can be used to for financial planning purposes. There are others, but the reverse mortgage is really the dominant program. So that's what we're going to be talking about. But this is not a sales job for reverse mortgages, but it is a special program for financial advisors to get a deeper understanding as to how they can be used or not in the financial planning process. Our agenda today really is the first thing to do is to clear the air. Reverse mortgages, although they've been around since 1989, they've gone through a number of changes and significant improvements over the years. But nevertheless, that they are not well understood by either consumers or financial advisors. There is perhaps a prevalence of misconceptions and negative reputation, which is unfortunate because that is a distraction from for people to get an understanding of what they really are. So we're going to talk about that. What it really is, it's a planning tool. And like any other planning tool the financial advisors have, they have home equity, which is, I was going to say arguably, but not even arguably anymore. For the great majority of people, is the largest single asset that they have. However, it's illiquid. It's like a huge block of ice that's there, although they have it, they can't use it. But the reverse mortgage is a tool that enables them now to convert some of that equity to financial resources. This is also an opportunity for financial advisors. It's an opportunity for advisors to gain a deeper understanding as to what how home equity perhaps could be used, and an opportunity for them now to reach out to and communicate perhaps new ideas to clients. And then lastly, we're introducing a new service that we're sponsoring. We'll talk more about that, but this is going to be a clinic for financial advisors to foster a greater understanding in how to not only communicate that, but how to evaluate the potential for their clients. Well, clearing the air again, these are the most common misconceptions, and it's on both sides of the table. It's both from consumer perspective and from financial advisors. One of the common ones is that from financial advisors, my clients don't want or need them, so they have little interest in knowing more about it. Number two is that I don't like them. They're loans of last resort. That's an unfortunate misconception that people have, but nevertheless true. Yeah, I might consider one someday if it's absolutely needed, but until such time, I'm not interested in it. And it only applies to people that have homes without mortgages. The homes have to be debt-free. Not true. And also, we're not interested because, as we know, the bank takes ownership of the home. That is not true. Homeowners never give up their home ownership. The home is a legacy for the kids. That's what the house is for. So we're not interested in doing anything with home equity. And also, with reverse mortgages, lenders charge exorbitant fees up front. Home equity lines of credit are a better choice. So those are some of the popular misconceptions that have fortunately deflected interest in people looking to learn more. Now, we have a video here. This is produced by the National Council on Aging. This is a focus group. And this is a takeoff, and you may remember the old Coca-Cola Pepsi challenge that they had. This is a challenge on the home equity line of credit versus the HECM, or the reverse mortgage challenge. We have a link to it, but unfortunately, when we were testing this prior to going live with the webinar, we found that this link did not work through the Zoom platform. It will be included in the in the recording that we're going to send to everybody. So I apologize for that. But essentially what it does, it's a focus group that included 88 consumers. And they went through that blind challenge on the whole thing. At the end, they were asked to choose which did they feel, product A or product B would be more suitable for them. And the result is that 85 out of 88 of the attendants chose the reverse mortgage as a more suitable program for them. So interesting piece demonstrating again change of attitudes. Now this is an advisor inquiry, and the questions that were asked to financial advisors, and this is a summary of that. And the first question is, how many of your clients could use a reverse mortgage? And the answer generally was very few, maybe 5 to 10%. So, and advisors really didn't see the reverse mortgage as a tool appropriate for their clients. They're looking at it more as the loan of last resort for people that are house rich and cash strapped. The next question is, how many of your clients are concerned they will be financially insecure in retirement? Not what you think, but what they think. And the answer was most, probably 80 to 90%. It's now well established that the number one fear among people throughout the country today is a fear of running out of money in retirement. And it crosses all lines, regardless of people that are perhaps better, more well-heeled financially. But that is the number one fear reported today. Then the question was, what if there was a resource that it could improve their cash flow, provide them with more liquidity, reduce sequence of return and other longevity risks? How many would want you to tell them about it? And the answer was virtually all of them. So it's not that financial advisors should be promoting the use of a reverse mortgage or anything else really, but it's more about educating clients and making them aware of what their options really are. Planning, I mentioned earlier that this is a planning tool. That's what it really is. And these are some of the highlights of planning. There's a number of different ways that they can be used. For today's session, we're really just hitting the high spots. Number one, the ideal planning client, and this is beyond the people that are cash strapped and less affluent, but a planning client which are being called the mass affluent. And this cohort really is people that are in their 60s or older. Generally speaking, they have assets somewhere between 500,000 and 2.5 million. That's the ideal planning client. What the reverse mortgage does, again, it enables home equity to be leveraged now and to be utilized in the planning process. And this is the versatility that it brings to the table. Number one, it controls withdrawal strategies. And I've highlighted that here because this is the number one reason that we have seen people, the motivation for them to take out reverse mortgages. For example, is that, and we've had two recent clients, both valuable properties down on Cape Cod, one a waterfront property, with clients that they were investment clients that had significant mortgages on their homes. And the problem is that they were taking withdrawals from their investment accounts to make the payments on reverse mortgages. In other words, they were cannibalizing their investment products. Now, with the prospects for decline, sequence of return risk and declining market values and so on, that accelerates the erosion of the investment accounts. With the reverse mortgage, and we're going to talk about it a little bit later, is that they have an alternative source now to draw funds from. And as a matter of fact, well, as you'll see, the reverse mortgage will eliminate any current mortgages that they have. Next, there is a reverse mortgage can provide a guaranteed line of credit. And we say guaranteed line of credit, that's exactly what we need. As long as they keep, as the borrowers keep the loan in good standing, which means that frankly, the only obligations that they have is to keep the real estate tax, homeowners insurance current, provide basic maintenance to their home, and continue to live in the home. The reverse mortgage can never be called. The line of credit can never be canceled, reduced, or frozen, and which is unlike home equity lines of credit or perhaps other home financing programs. This is a unique program in that it is a non-recourse note, meaning that with the reverse mortgage, the borrowers take on no personal liability. The liability is 100% on the property, where there's no personal liability for either the borrowers or their heirs. It doesn't even appear on their credit report. Trust ownership. Many more affluent clients have transferred their home ownership to a trust for different estate planning purposes. It is often assumed that you can't do a reverse mortgage with a home that's owned in trust. That's not true. The trust has to be approved, but whether it's a revocable or irrevocable trust, the reverse mortgage is a potential candidate. There's no maturity date to the loan. The people who we're talking about, aging people, the great majority of them want to age in place. They don't want to leave their homes. With the reverse mortgage is designed, there's no maturity date. So as long as one of the owners continues to live in the home, the loan can never be called, period. And to be exaggerated a little bit, if someone lived to be 120 and they continued to live in the home, this loan cannot be called. So they are assured that they can remain in their home. And further, there's a limitation on what the mortgage balance will be at the end of the line when they pay it off. In fact, the mortgage balance that they will owe can never exceed the property value. So in the event that the loan balance grew to be greater than the property values decline, at the end of the day, they are never responsible for more than what the value of the property is. Cash flow. As we know, the planning process ultimately really is focused on two planning considerations. Number one being cash flow, and number two being liquidity. As we go into retirement and into our withdrawal years, the big questions are, do we have enough income to meet our obligations, and do we have enough liquidity to meet whatever financial obligations may come along? So what the reverse mortgage immediately does, it will eliminate or pay off any existing mortgages or liens on the property. And there's perhaps additional funds to pay off other debt obligations if people want to do that. The point being is that they have the ability to eliminate or to reduce debt obligations that are impacting their current cash flow. Number two, there is additional funds available, perhaps in the line of credit, that can supplement their cash flow if it's needed, so that they can maintain their current lifestyles. Moving on to liquidity, because we're able now to tap into and to create liquidity, we're calling the reverse mortgage a buffer asset. A buffer asset in that it is able to convert an illiquid asset, home equity, to a liquid asset, cash or a line of credit. And that is a source of funds that is in addition to whatever other financial resources they may have. The funds, by the way, can be used for any purpose. So there's no restrictions on the use of the funds. People have the choice. They can be prudent or they could be imprudent. Clearly, we all recommend a high degree of prudence. Number two, the funds can maintain or enhance lifestyles. It's whatever they want to use it for. It also facilitates what we're calling discretionary funding. In other words, people that perhaps want to improve their lifestyle, whether it's buying a second home, a vacation home, recreational vehicle, travel, or whatever. We've had clients, and most recently a client who was very well positioned financially. They had a home here in Massachusetts with no debt on it. They did the reverse mortgage to take all of the funds into made gifts to grandchildren for college expenses. That's something that they wanted to do. We've seen that used to make charitable contributions. So it opens the door and it unlocks the equity to enable people to do more things. There are certain tax considerations that come into play here as well. One of the ones is for funding Roth IRA conversions. That can be a very worthwhile strategy for some people, but it can take a significant amount of upfront cash to affect the conversion. Well, without depleting investment of funds, is that the reverse mortgage could enable that to occur. The withdrawals, by the way, that one takes from a reverse mortgage, whether it's a periodic withdrawal or it's a lump sum cash withdrawal, it comes income tax free. So there is no state or federal income tax due on it simply because it is not income. It is a distribution from a loan. Now that is important when people are withdrawing funds, people that have been withdrawing funds, say from an IRA or a 401k account. Because as they withdraw funds, those funds are not only reducing the investment portfolio, but they've created an income tax obligation. Well, an alternative to that could be a withdrawal from the reverse mortgage that would come to them tax-free. It also provides funds that would enable people to delay implementing Social Security benefits. So today, if you can delay receiving Social Security until you're age 72, then you will have maximum lifetime income from Social Security. But during that period of time, from when they were originally eligible for it to currently age 72, the reverse mortgage can provide perhaps cash flow that may be needed to get through the deferral period. And this provides funds that can provide contributions to other tax advantage or insurance accounts. For example, for long-term care insurance premiums, certain annuity investments, or other considerations that require liquidity. So there is a number of different considerations there. In addition to providing access to cash, we're also concerned about reducing retirement risk. Sequence of return risk today is at the top of the charts. Clearly, as we are all aware, there's nothing but uncertainty ahead as we ponder the imponderables of the world situation with the pandemic, the war, supply chain, inflation, all of that, and what's going to happen to our investment portfolio. Just in the last 2 days, we've seen the Dow drop well over 1,000 points and so on. So as people are withdrawing funds from their investment portfolio and their investment assets decline in value, they have to convert more more financial assets to cash, which accelerates the decline of the investment portfolio. There is an alternative to that is to be able to switch and draw the cash needs from the reverse mortgage, leaving the investment portfolio alone, so that they're not creating the sequence of return risk. We actually have another whole session on that exact strategy. And longevity risk. Again, I mentioned it earlier. The number one fear across the country today is people are worried about running out of money in retirement. We're concerned that we have enough savings, and thanks to medical science, we're living longer. The question, will we run out of money? Well, of course, with the reverse mortgage, what we're doing now, without selling the home, we're converting some of that equity to cash or to credit, so that we have more financial resources to stay the course. Healthcare risk. This is an unknown concern for everybody, regardless of how well people may be or may not be. There's the risk of healthcare risk that may require us to get additional care, whether it's in-home care or nursing care, or perhaps to be able to afford long-term care insurance. Healthcare risks are a major concern, and we're blunting that concern a bit by providing access to more funds. It also provides a virtual hedge. Now, what I mean by that, and you'll see it in a demonstration in a moment, with the reverse mortgage, when we close a reverse mortgage, we're locking in today's values. Today, as we know, we have never seen property values as high as they are. So we're at historic highs right now. And because it's a non-recourse loan, we are locking in the value of that property. And if future property values decline, it does not affect the access to the funds that we have. It also provides a virtual hedge against increasing interest rates. I'll explain that in a moment too, because with the credit line that's established by a reverse mortgage, we have, it is a growing line of credit, meaning that the undrawn portion of the credit line grows and it compounds monthly at the same rate that is charged on the funds that have been used. Of course, one of the big advantages of a reverse mortgage is that it enables people not only to borrow the money, but not to have any obligations to make mortgage payments. Again, we'll see that in a moment. And I mentioned before, there's no maturity date on this. So this assures people that want to age in place that they can remain in their home indefinitely, again, as long as they keep the loan in good standing, which is keeping their property charges current, providing basic maintenance as may be needed, and continuing to live in the property as their primary residence. In terms of guarantee, they can't be changed for the life of the loan. Now, how they work. There are two types of reverse mortgages. There is what they call the home equity conversion mortgage, called a HECM. That's the trade lingo on it. And that is the most common, is the FHA insured reverse mortgage. It goes back to 1989. It's guaranteed by the federal government through the FHA insurance program. Next to that, and this is a relatively new development, in Massachusetts, they only became available to us in February of 2020. And these are new, what we call proprietary or jumbo reverse mortgages. They provide loan limits far in excess of what the federal program does. And it does not have the restrictions that some of the FHA programs require. So to demonstrate that a bit, let me toggle over now to another program in here. Okay. This is a program, a software that is provided by one of our lender partners here, Finance America Reverse. And what we're going to do here is demonstrate, initially I'm going to demonstrate the FHA program. So ahead of time, I inputted the date of a 62-year-old individual. That's the minimum age for a borrower to be eligible for an FHA reverse mortgage. And further, I've assumed a property value of here $800,000, which is really close to the median price here in Massachusetts. For openers, I'm assuming that this home has no mortgage balance on it. And here is a Massachusetts zip code, so that this is a Massachusetts homeowner that does not have a mortgage. So we click the update button here, and let me show you a graph and how this might work. Okay, the blue line at the top shows their home equity. Now that is their property value. It started out at $800,000. In this program, the default assumes that the property is going to appreciate an average of 4% per year over the years. So you can see how the property value is increasing. Now, prior to doing the reverse mortgage, they had no mortgage balance. And now we're putting a reverse mortgage in. And just purposes of this illustration, I'm not assuming any upfront costs. And at a later time, we can get into what the upfront costs are. But I'm just trying to illustrate a concept. So here now we had a reverse mortgage loan balance, and here's what the breakdown would be. The property is worth $800,000. In the calculation that determines how much they would, which includes the value, there's age 62, in current interest rates, this individual would be eligible for funds of up to $339,200, and assuming that would be available to them in a line of credit. Now, although they are not obligated to make any mortgage payments along the line, the payments can be deferred. And currently, at this illustration, the interest rate would be about 3.8%. But a federal mortgage insurance premium of 0.5% is added to that, so that the total annual cost would be 4.3%. Now that 4.3% would be charged on with the funds that they've borrowed, but it also applies to the credit line. So showing you the credit line here again, is that credit line now is growing at 4.3%. We can look at this a little more granular here. This is the data set now that supports the graph we just looked at. So we have year by year comparison. With this program, these 4 columns here, the home appreciation, annual withdrawals, monthly payments, and interest rates, we can do what-if analysis, and we can change that to make any assumptions. So here, assuming that nothing has changed, that the interest rates have remained the same, we can see that their line of credit has grown from 333,000, I guess it was, up to 354, 369, and so on. But we can now input, changes in here. So this is an individual that has no mortgage on their home, and they can draw those funds at any time. Let's look at let's change it a little bit here. And let's say that this is a 62-year-old. He's continuing to work, doing whatever he's doing, but perhaps he has $125,000 mortgage on his home right now. Well, what if he does nothing? What will he do? he'll make his mortgage payments, and he'll continue to make his mortgage payments until he pays it off and he owns his home. But what if he swapped it for a reverse mortgage? Well, let's look at this. Now we go back to the chart. If he swapped it for a reverse mortgage, now the reverse mortgage is going to pay off the existing mortgage that he has right now, as indicated by the red line there. Going forward, he has no obligation to make any mortgage payments. And you see that the line of the balance owed is growing because there will be the interest charge of that, the annual charge of 4.8% is going to be added onto his loan balance. So the loan balance is going to be increasing. We call that negative amortization. But in addition to that, he also has a line of credit available to him. That line of credit is growing as well, because the line of credit will grow at the same rate. In this instance, about 4.8%. It's going to grow in compound monthly. So we can see the effect year after year. So after the, for example, if we went out 5 years, for example, well, his home would have increased at about a little over $1 million. His ending loan balance would have increased from 125,000 up to 152,000. His line of credit now would have increased to 277,000. So he can draw upon those funds at any time. So that represents the effect if they just swap the reverse mortgage for a traditional mortgage for the reverse mortgage. Let's look at a little bit differently now. Now, currently, this individual is making payments of, let's say, $1,500 a month. What would the effect be if he swapped his current mortgage for a reverse mortgage, but he continued to make the $1,500 monthly payments? Doesn't have to, but they'd be voluntary. So here we enter that as a negative number. And if he continued to do that, how long would it take to pay off the loan balance? Well, let's go back to the chart. So now what we're showing is that, okay, those mortgage payments now are reducing his loan balance. We get out here to about year 9, I guess it is, and we paid the mortgage off just like he would be if he was continuing to make his mortgage payments. However, he created that credit line, and you can see how the credit line is increasing because 2 things are at play here. Number one, we have the credit line growing and compounding at the rate of 4.8%. But also, every time he makes a voluntary payment of $1,500, it increases his credit line by $1,500, so that the credit line is increasing and compounding at a higher rate. And by the way, those payments, voluntary payments that he's making, he can get them back at any time. Unlike with the mortgage that he has right now, he's making payments. He can't withdraw those payments. Here they can. So now you can go out, and he gets out now to year 9. He's paid his mortgage off. Now the property is worth $1.1 million, but he also has a line of credit of $522,000. That is a liquid resource available to, in addition to whatever other savings that he has. So that what we're demonstrating here is what can be done, and we can do what if scenarios here to make voluntary payments, to withdraw funds, to change the appreciation. We can do that. And that's part of the service that we're going to be offering to you. I'll describe momentarily, where we can customize illustrations for clients to see what the near and perhaps longer term effects of the reverse mortgage might be. Now, we also have the jumbo reverse mortgage, which I'm not going to get into right now, simply because of the issue of time today. But basically, in Massachusetts, the Division of Banks has just recently approved loan amounts up to $2 million. So we have for higher valued properties. And we've used this for the properties on Cape Cod. We had a client down there with a home that was worth a little over $2 million. They had a $450,000 mortgage balance that they were making payments by withdrawals from their investment account. We did the reverse mortgage. It paid off the $450,000 mortgage, provided them with another $300,000, which added to their liquidity in addition to their retirement savings. So it stopped the bleeding, the depletion of their retirement savings. It gave them more liquidity, and again, with no maturity dates. So Steve, I'm going to go back to our, I can.
Well, George, maybe while you search, I will give you some of the questions that came over.
Please do.
And if you could respond, that would be great. One question is, a financial planner heard some rumblings of the expanded use of reverse mortgage and condo ownership. Can you expand on that?
Yes, I can, Steve. Yeah, condo ownership has been a problem for people looking to access a reverse mortgage up until just recently. In order for a condominium owner to use a reverse mortgage, the entire condominium complex had to be FHA approved. In Massachusetts, less than 8% of all the condominium associations in Massachusetts are FHA approved. So the 92% had no access to a reverse mortgage program. There's been some new developments at FHA recently that enables us to do effectively what's called a spot approval. So it makes that process a little bit easier. But especially for the higher end properties, condos that are worth $1 million and up from there, that could benefit from the proprietary program. There was never any reverse mortgage financing available to them, but it is available now. So condominium owners, have a new opportunity to tap into some of the benefits that can be provided.
Okay, thank you. And then another question was, some financial planners are unfortunately helping couples through a silver divorce that is becoming more and more, unfortunately, common.
Yes, and we've had experience with that, Steve. Yeah, in the silver divorce, when it comes down to the question of the home, short of selling the home, obviously that's a common strategy. They sell the home and then split the proceeds of it. But I can describe one situation that we had here where the wife wanted to retain the family home for the kids and so on. The solution was we did a reverse mortgage for them that provided her with the funds that enabled her to buy out her ex-husband's interest in the home. So it now turned the home ownership over to her exclusively, and she has no obligation to make mortgage payments. The proceeds that he received enabled him to go out, and in his case, he bought a condominium. Typically, what people do, they'll buy their retirement condominium for cash. What we were able to do is use the reverse mortgage for purchase. where he only had to put 50% down, and then fund the remaining 50% with a reverse mortgage. That enabled him to acquire ownership of the home, have no mortgage payments, and have the other 50% in the bank, so to speak. So the situations of a silver divorce, as you mentioned, the reverse mortgage can be an important tool in planning the financial distribution from that.
Okay, and then there's another question about what's the most common age that people seem to be exercising their option of applying for a reverse mortgage?
Yeah, usually this is in the late 60s or early 70s is what we commonly see. However, frankly, when people understand how this really works, the ideal time to do it is that as soon as that they are eligible for it, which is why I demonstrated a little earlier a 62-year-old. That's the minimum age for the FHA program. But there's no, so 62 is the minimum age. There's no upper age limit. We've done them. We just did one for a woman that was 101 years old. And this was a woman that was in a nursing home. And all she wanted to do was to come home and to spend her whatever day she had left in her home. She had a home in Canton. There was no mortgage on it. Her children came to us, and to shorten the story, we did a reverse mortgage that provided access to a significant amount of money, which enabled her to come home. But she required 24-hour skilled care, and she required the expensive medical equipment. That cost was on the order of $18,000 or $19,000 a month. The reverse mortgage enabled her to come home, to live in her home, and she actually lived there for a little over a year. So that's another example. So there's no upper age limit to it. And generally speaking, on the low end of things, is that in the 60s, generally speaking, they'd be eligible for roughly on the order of about 50% of the equity, up to, and older people are eligible for more. And generally speaking, it's up to about 2/3 of what the property value is.
Okay, and another question was the admission that there's a lot of detail here. Financial planners are feeling a bit overwhelmed with how much they should know, and the fluidity of sharing that information with prospects, with clients. How would they work with you to have a good resource and bench strength to share this information with clients?
And I just put it up on the screen now, Steve, and this is we are introducing and making available to financial advisors, for lack of a better term, what we're calling a home financing advisor clinic. And this is a service that we're providing to financial professionals, more specifically financial advisors, on the ability for them to access information and service resources that will help them to be able to more easily identify clients that may be suitable candidates for the reverse mortgage, or for that matter, another equity tapping resource. Subscribing to this program, which there's no cost for it, enables them to call in to get information and client analysis. It also opens them to a forum. We have other financial professionals, most notably estate planning attorneys, elder law attorneys, that have volunteered to assist here to be able to answer questions as advisors are contemplating whether something would make sense for a client or not. In addition to getting the home financing considerations, there's also implications for estate planning and elder law matters. So this is, again, it's a very integral tool that affects not only the home financing, but can affect estate planning and others. So we have made available these legal experts to be a part of a forum that is available to answer advisors' questions. Then thirdly here, what we're launching is a periodic newsletter that we're going to be sending out that will keep people updated on new developments to equity conversion, different best practices on being able to tap into it. And also we're going to be bringing into it contributions from other industry and legal experts on that. So there'll be a constant supply of updated information. So we're presenting in this, for lack of a better term, as a clinic for advisors to call and to get information. And then if they choose, we're available to help them to communicate with their clients on how this works, what it does, what it doesn't do, how it may be appropriate for them, and just as importantly, where it may not be appropriate for them. So the real question gets down to, does it make sense for aging homeowners to tap into and use home equity? The answer is different for everybody. It's an individual situation, but what they need is access to qualified information. And that's what we're proposing to do. To the best of our knowledge, this is a first of its kind service. So after the webinar is over, and we'll be contacting people that attended to explain this a little bit more and to enable people to sign up for this service if they would like. So I see we're getting close to the end of the hour, Steve. And are there other questions or?
Those are all I see, George. So I think what probably makes sense for certain is to give people a better sense of how to reach you.
Certainly. And this is my contact information here. It's on the screen. And I'm calling myself head coach because that's what we're really doing here. We're providing a coaching service to people. This is not about selling reverse mortgage or selling anything for that matter. It's about helping financial advisors to get more information and to be able to evaluate client situations to determine what could be a recommended course of action for them. So that's our information there. We'll be reaching out to to people that have attended to get their feedback on this. Also, we're going to be making available a recording of this session. Is that correct, Steve?
That is correct, George. We will be sending that out within the next day or so.
Okay.
So I think if you've covered your subject completely, I think we thank everybody who has joined us, and we will keep you appraised of upcoming other webinars related to this topic and other information related to this topic. And we thank you for joining us today.
Good. Thank you, everybody.
George, thanks for your help. Take care, everyone.